Hello and welcome to a breaking news special here on Soar Financially. We have just witnessed the Fed cutting 25 basis points. I just watched the press conference and it couldn't be fuller of contradictions. There are contradictions everywhere. The Fed doesn't really know what is going on. The dot plot is all over the place. And we don't really know what to make of it. The market is all over the place as well. Just looking at the S&P chart, it's up, it's down, it's up. The market doesn't know what's going on either. Really, really interesting. Lots of contradictions. As you know, I've invited Lobo Tiggre. He's the independent speculator onto the show. He keeps claiming he's not an economist, but yet he's probably the best commentator I can find to discuss what the Fed is doing and what Jerome Powell is saying. Is always fun to chat with. I'll bring him on in a few short seconds. But no, you know what? I'll bring him on. I was going to rant for a second because I have some observations that I wanted to share with you. But Lobo, let me bring you on first. It's good to see you. Thank you so much for joining us.
Happy to be here. You know, I worked at George Mason University, was the Center for the Study of Market Processes, which became the Mercatus Center. And the PhD students, you know, I wasn't one of them, but they talked to me about economics. And I would say, I'm not an economist. And they'd say, well, you ask questions about economics and you think about it. Therefore, you are an economist. So maybe we can roll with it.
Maybe we're all economists a little bit, you know, like internally, maybe. Right. Lobo, before we get started in the discussion and your takeaways and all, let's take a quick look at the market reactions. I've queued some charts here real quick just to take a look. S&P 500. It is all over the place. Look at this. It looks like a heart rate monitor, doesn't it?
Yeah, it does.
Absolutely insane. That's just a daily chart here. Same with gold. A little worse than the S&P 500. One thing that I find really interesting, of course, the DXY as well. It dropped massively, recovered. Now it seems like it's just hovering along and tinkering along. Really, really interesting market reactions. Now, Lobo, what do you make of all of this that we're seeing here? What is your opinion? What's your first gut reaction to this Fed rate cut?
Well, the first gut reaction we can see in the charts wasn't the 25 basis point cut. That was largely telegraphed. There was a lot more expectation and more dissent. And so merely a quarter point was so unanimous, with one exception, and we all know who that was, right? Or we think we all know who that was, but I think it's pretty obvious, right? I mean, that might have shaken the market up more than anything else. Just that immediate, like, oh, wait, you know, we thought there was more concern here, and you know, there was talk about a 50 cut, and that basically wasn't on the table except for the one guy, right? So I think that made people, you know, sit back, and then give them a few minutes to look at the dot plot, and it's actually quite funny. I just tweeted about it. There's the dots, right? Everybody in the middle, and then there's this one dot way down there. We all know who that was, right?
Here, let me bring it up on the screen real quick so everybody can see what we're talking about.
Yeah, look at that dot down there.
It's like right there.
Yeah,
well,
that's
you can't see
Trump
my mouse here, but
right? That's what Trump's saying. You know, slash it 100 basis points now, 200. Why not? Right? Yeah. So, on the one hand, you could laugh that off and say, "Well, this one outlier is not going to move the whole committee of 12." On the other hand, you know, Powell's term is up now in less than a year, and if you know Trump's going to nominate the successor, so markets are forward-looking, and they're starting to think about, well, what if this is the impact of one Trump guy? What if we get two Trump guys on there? Or this Trump guy becomes the most powerful voice on there. So I can see, a delayed reaction as people think about this and go, And then, of course, there's the press conference. So there's the initial reaction to the press releases. The actual statement was not a big deal. I think it was as expected, but the dot plot did shake things up. And then Powell starts talking, and he said a lot. And a lot of it, I think, was not really that important. A lot of people had questions about the Fed independence, and it's not that that's not important, but I don't think that was going to move the markets today. My take is the moment when I started seeing things reverse and move was when Powell talked about, yes, we're more concerned about the labor side of our dual mandate. And yes, we think tariff inflation from the tariffs is likely to be, he didn't say transitory, but one-off, short-term, right? But he said then, but we don't know. We don't know for sure. The tariff policy changes are ongoing, and there could be longer-term knock-on effects. So that really opened the door for not transitory inflation. And the Fed has to pay attention to that. At least, half of its dual mandate is the inflation side. So Powell saying, like, everybody's been so confident of these rate cuts because the labor market's weakening. And if there's an inflation argument, it's transitory again, right? It's just a one-off from the tariffs. And Powell opened the door for it not being one-off, for inflation actually still being a more serious and ongoing problem. I think that's when people said, "Ooh, wait a minute." And I think that's why we saw the DXY reverse, because, there was a big re-rate of what are the odds here? And there was a bigger argument to be made for less dovish policy than I think a lot of market participants expected going into this.
Very contradictory, as you said. Like, the data itself is pointing in two directions: higher inflation, higher unemployment. Like, how do you find the balance? And he said it himself. He was tiptoeing the line, not trying to use the word stagflation again.
He tried so hard, but he said it. He said our two mandates are in conflict, right? Yeah. He wasn't, and that's basically admitting that we have stagflation.
Yeah, pretty much, because he says usually inflation is low when everything's going well or not going well, and inflation is high when everything's great, and it's exactly the opposite. So
and he also said, I mean, even it was striking admissions in a way. He also said our tools don't work that way. Like, we can't do both. They work one way or the other. We can't do both at once. He didn't use the dreaded S word, but it was really a quite striking admission for the Fed's sort of helplessness in this scenario. And hat tip to our friend Lynn Alden for pointing out that in periods of fiscal dominance, that monetary policy becomes, if not useless, then at least less efficacious.
Now, lots of direction we can take this now, but there are a few things. Like, I need to mini rant here maybe a little bit, because I'm quite annoyed with the questions that we're asking. You touched on it, like all the political theater within that.
Like what was Paul going to say? Yeah, I'm worried about Trump.
Is really annoying me, because I wrote down a few questions I wanted him to answer, and maybe we'll start there, because he said, like, when he read from the script, like, we'll continue to reduce monetary holdings. I was missing some information on that. Like, what does he mean by that? Like, we've talked about this before, Lobo, you were on. We talked about QT being reduced to 5 billion. Are we still at 5 billion? Are we at zero now when he says reducing monetary holdings? Like, what does that mean? Nobody's answered that question or asked that question. That's the one I would ask, for example, right? Do you have an opinion? Like, I couldn't find anything on it.
Well, in a way, this could be the Fed's answer to being caught between its two mandates. They see the weakness in the labor market, so they want to try to cut interest rates a bit to try to help out there and not get too carried away. I do think Powell is well aware that if he just says, okay, forget about inflation, it's transitory, all we got to worry about is labor market now, and they cut too much, and inflation really does go much higher and stays higher, then his dreams of being praised as the next Volcker just go out the window. His legacy will be the next Arthur Burns. And I think he really, really doesn't want that. Or, whatever, Trump can fire him or whatever else happens, he doesn't want to be remembered as an Arthur Burns. If he gets fired for being a Paul Volcker, I think he can live with that, right? So he's stuck in this place. But one way to sort of like pussyfoot around it, frankly, is to, cut on the one hand, but also continue cutting the balance sheet, which is a tightening, right? That does have a tightening tendency on policy. And, even if one is to be as charitable as possible with Powell, that balance sheet needs to be cut anyway. Like, almost regardless of what else is going on, we blew that thing out to, 3x over the GFC levels because of the COVID-19 problems, the lockdowns and everything. So I think the Fed has, anybody rational in that body is aware that they do need to normalize that balance sheet, that if they don't, and if we monetize all of that, that really is money printing in a big way. So I think they try to talk about it as little as possible. Remember his famous paint drying remark? I think they would really prefer this happened in the background. But the two ways of looking at it is, one is that, ultimately at the end of the day, that balance sheet does need to be cut. And then the other way of looking at it is, maybe this is a little bit of a way for the Fed to hedge its bets here. They have to They have to cut. They have to appear to respond to, you know, the big cuts in the labor market, revisions and all that. Though Powell dismissed the revisions, saying, "Oh yeah, we expected that anyway."
Like our model was spot on.
Yeah, right. You know. Well, anyway, so I think it's maybe speaking out of both sides of his mouth, which, you know, that's kind of his job, isn't it?
No. Yeah, it probably is, right? He's got to make he's got to be a people pleaser, right? He's got to be a market pleaser, I guess, as well. He's got to play both sides of the aisle as well. Let me bring up the summary.
Right. Sorry, let me just jump on that remark that you said, because I think that's, I mean, it may just sound like we're dissing Powell or calling him names or whatever, but I actually think what you said is literally true, Kai, because he also even re-emphasized this. The mainstream economic perspective is that it's all about confidence, right? And Powell has said that if people think inflation is going to be 5%, then it'll go to 5%, because, you know, they'll front run it. They'll try to, you know, they'll bid things up before it gets to 5%. And that pushes it in that direction. And, you know, all these different confidence numbers, they at least espouse the belief that what people think or believe is where things go economically. So if it's his job to guide the great ship of the economy, then by their definitions, it's his job to guide expectations and confidence. So we're not just throwing insults at him. That's his self-defined nature of his job.
Yeah. Allow me a personal comment here about Jerome Powell. He seemed extremely shaky at the beginning of the press conference. The first 15 minutes, he seemed to be tripping over his own words and was very shaky, in my opinion. And he gained some confidence towards the end, but he seemed very, I don't know, almost nervous. Like I felt like I heard dry mouth as well, which you get when you're nervous. Of course, I get that as well when I'm on stage. I can attest to that. So that's just me reading it maybe into it, but he seemed very nervous. He gained his footing later on, but the first 20 minutes after reading from his statement, he seemed very shaky. Did you catch that as well, or is that just me?
Well, I mean, that's not hard data, so I'm not sure.
No, it's just something I observed.
But I will say that his questions at the end, he did sound, I think, much more confident.
Yeah.
I don't know about dry mouth or whatever, but it did seem that by the end of the press conference, he had hit his stride, and, you know, he was knocking off the answers right from the playbook. Page 3 of the 3-ring binder answers this one, right?
No, absolutely. Let's talk hard data. I've got something prepared here, still from the summary of economic projections, real quick, because the one deciding factor for a rate cut really was the unemployment data that they've been getting. You touched on it. Well, they expected the exact amount of revisions that they got. Yet they're still,
they'll tell us now they did. Exactly,
right? But they're still talking about, and let's make this red here, about this part. Terrible mouse writing here. But 4 to 4.5%. So they're expecting higher unemployment rate. And I have a couple of questions. A, why are they putting so much emphasis on this? And B, why are they so nervous around about 4 to 4.5% here? Why should they be?
Well, if you start from where we were before this exercise, that are 3.5, arguably slightly lower, depending on how you defined it, 1 whole percent, that's a lot of people, and it's a lot of voters. That's a lot of people to not feel confident and so on. And here I have to sort of theorize, because I can't prove this, but my sense is that despite what they say, and again, as we were just talking about, if his job is to manage public opinion and that, he's got to toe a certain line. But I think they know that the U3 unemployment rate, which is the numbers you were just charting there, is not comparable apples to apples to the way it used to be. So when people talk about, oh, we have historically low unemployment numbers, well, that's simply not true. You're comparing U3 now to what was more similar to U6 before, and U6 is up around 8%. So, I mean, it's just not true. And I think they know that. They're economists. They have to know that these are not apples to apples comparisons. So if they know that but can't say it, then it would make sense for them to be a bit more nervous. And another way of looking at it is you get to sort of tripping points or thresholds. And okay, maybe from 4.3 to 4.5 doesn't sound like that big a change. But if 4.4 is the straw that breaks the camel's back, then 4.5 leaves you in a world of hurt.
No, it's let me bring the screen back up here, Loa. Just one thing, because I was listening to the remarks and I was wondering, like, they didn't give me any reason to be confident that the unemployment rate will actually drop in a couple of years. Reminds me a bit of the the inflation rate. Yes, we'll get to 2% in 2 years' time. It's always free beer tomorrow. You'll never get the free beer, right?
Which, oddly enough, that was maybe the most daring question of the lot.
I like that one. Yes, Mike McKee
they
asked
don't
a
let
good
anybody
question
in
there.
who can ask hard questions. But somebody said, "Hey," and it was a mainstream reporter. It wasn't. I don't know. It wasn't. I don't think it was even like a Fox News or somebody.
No, it was Bloomberg. It was Mike McKee from Bloomberg.
Okay.
Yeah.
Oh yeah, Mike McKee. I'd like to talk to him off camera because he's one of those people I think knows a lot more. I mean, he's clearly smart. But anyway, yes. So brilliant question. And Powell, amusingly enough, he didn't just dodge it. He said, "Yeah, it's true. Like, that's just the nature of the business of making projections." But the other thing, so the other one that got talked about a lot, and I think is more important than the 4.5 on the unemployment rate, is the higher projection for inflation going forward. Like, I mean, that's really striking. That they're saying, maybe it's transitory, but whether it is or it isn't, they're saying inflation's going up, but we're cutting anyway. To me, this is the biggest contradiction of the whole thing. And, you have to wonder, I'm not trying to lay out a new conspiracy theory here, but, we have to wonder, like, why did, I forget the name of the lady who suddenly resigned from the Fed. And so we have this new Trump appointment. Like, why would that happen? Maybe what's happening with Lisa Cook now, maybe somebody told her, "Hey, we've got some dirt on you. And, if you go quietly, we won't tell anybody." I don't pretend to know this. I'm just saying the sudden resignation was very suspicious, and look at the impact it's had already. Lisa Cook may hold on to her position. It looks like there's other data now that says that she did say that the second house was a vacation home. So we'll see. But it's clear that this administration is putting, if not entirely unprecedented, then no question, extreme pressure on the Fed. And even Fed members, they're human beings and they can feel that. And the carpenter of Nazareth once said, "Let he whose slate is clean throw the first stone," and everybody put their stones down, right? There's nobody with an entirely clean slate. So you got to wonder, what sins do these members of the FOMC have that they don't want to get out there? And, they don't know what the other side knows or has on them. So, I mean, it's a legitimate question to think about how Fed policy might change going forward, depend on how ugly the politics gets.
I just have to think of the life of Brian. Like, everybody enjoys a good stoning,
That's right. Wait, are there any women here?
No. Amazing movies, phenomenal. Now I lost my red thread here. There are a lot of topics to discuss in terms of inflation. You mentioned, of course, inflation not going down. Why cut? The Fed meeting the market. I had one good follow-up question to you. What you just had there. Now I've lost my thread here. But why? Actually, let's throw up this question here on the screen. So stop go, and I apologize for probably mispronouncing it. But will the Fed actually go for 2 rate cuts this year? They've lied before. Of course, the last part is a bit subjective here. Or objective, subjective. I always confuse the two. What are your thoughts? Like, will the Fed cut twice this year? Will we see more cuts?
Well, they say they're data dependent. So if we get more degradation in the labor market, which is not an unreasonable expectation, we still have Trump shock just now starting to work its way through the real economy. And I always, I say the word Trump and I get hate in the YouTube comments because I didn't talk about how wonderful our glorious leader Trump is saving America. And I get also people hating me for not beating up on Trump enough because he's crazy, right? But whether you love him or hate him, there's an agenda here. And at least based on the reports we have, people took shots at Trump. And there's 2 assassination attempts, maybe 3 that we know of, right? So you think he's not playing hardball? You think he's not going to go as hard as he can to achieve his agenda, whether you agree with it or not? So I think that's worth thinking about. But the economic data itself may continue to be split. The weakening labor market would give the Fed time or cover for cutting some more. But if we're right about inflation, then that, or even if they're right about the transitory inflation, that means there will be the inflation, and they may dismiss it and say, oh, it's transitory or short term or one-off, whatever words they use, that acknowledges that it's going to be there. So the expectation is for more stagflation, for more weakness in the labor market and higher inflation. So, that really puts them in a bind. And it comes to the question of which side of the dual mandate do we emphasize? And Powell addressed this today, and he says that traditionally their way of doing it is, okay, we've got dual mandate, our policies in between, which one is closer? So like if we're farther from helping the labor side, well, then we'll move towards labor. And if we're farther from helping the inflation side, we'll move in that direction. But when you really don't know, or you're like the donkey caught between the two barrels of hay and starving to death because you can't make up your mind which way to go, it's a mess. And whatever they do, there's going to be a cost. Like if they move towards weakening, loosening monetary policy to help the labor market, that throws the dollar under the bus, which is what the administration apparently wants. If they do say, oh, wait a minute, this is more inflation than we bargained for, or it's looking stickier than we thought, then they throw the labor market under the bus. So it's a no-win scenario. And actually, the good news here, despite today's volatility, is that this is really good for gold. I mean, everybody knows what happened the last time we had stagflation. The more painful the situation gets, Kai, the more people will remember, well, what happened last time we had high inflation and weak labor markets? What was the stagflation play? And it was oil and gold. And oil is in a different market right now. We don't have OPEC cutting oil supply. We have OPEC ramping up oil supply. So that leaves gold as the most obvious go-to space here. Maybe it doesn't look like it today, but going forward, the louder that stagflation drumbeat gets, the better that is for gold. And that's a scary thing for me to say at $3,700 gold. But that's the way it looks to me.
Yeah, it is scary because we got one question. Let's stay on the topic of gold for just a second. And you shared your insights there already. But Victor asked, what are the outlooks on gold? But maybe we can get just a tad more granular. Why do you think it is actually good for gold? Like, because I look at the market reaction first. Hey, we get 2 more rate cuts this year. Great. Gold jumps up to 37.06, 37.08. In the meantime, it drops, like while Powell speaks, it drops down to 36.45, like massive intraday, drop almost to, 80 points here, 60 points, math, but why is it good for gold? Maybe let's get just a tad more granular there. Lobo.
Sure. Well, first, looking at the market gyration, that's almost never a good or a clear signal. I mean, it's important, it's relevant, you need to think about it. But the immediate knee-jerk reaction is almost always wrong. And the thing to remember is that those knee-jerk reactions at the beginning, that's not you or me or the average gold bug calling up their stockbroker and saying, hey, sell my gold stocks. I've changed my mind. Or, that's not the mom and pop, bullion buyer running down to the local coin shop and buying or selling a few more ounces. This is traders trading with their algorithmically programmed machines, and they've got triggers. Oh, if this happens, then sell, or if this happens, then buy. And then afterwards you say, well, wait a minute, that happened, but not for the reasons we thought. So reverse course. So it's very dangerous to put too much weight on the initial market reactions here. They're not human reactions. They're algo reactions, and the algos are often, programmed wrong. So that would be the first caveat here. In terms of the gold market going forward, even before we talk about Fed policy and fiscal dominance and all this stuff, remember the central bank gold buying. That really has been a game changer. It has clearly put a much higher floor under gold. It's not done yet. Maybe someday, years down the road, central banks will stop buying gold. Maybe they won't. Maybe they'll continue moving that way for beyond our investment time horizons. But right now, that's really important because it's not like it was the last time around. So that's one thing. And that makes me less nervous about being a gold bull, even above previous all-time highs. The other thing is, don't forget the fiscal dominance. So, okay, it generally speaking, lower rates should be good for gold because gold doesn't pay interest, right? Though there is an alternative for that right now. But anyway, there's an app for that. So if the signal we got today is that the Fed is going to err on the side of protecting the labor market and cutting rates, that's actually bullish for gold. Never mind what the algos did today. That on itself historically has been bullish for gold. Now, if the inflation side comes back and comes back, stronger, and the market decides, oh, well, the Fed said they were going to take care of the labor market, but they're actually more interested in inflation. This is not what's happening now. But if that did happen, ironically, that would be the knee jerk would be negative for gold because gold doesn't pay interest, and higher, rate increases are supposed to be bad for gold. If that happens, I think that would create a fantastic buying opportunity because at the end of the day, inflation is inflation, and anything real, anything that governments can't print, goes up as the printing continues. So basically, never say never. But if I'm going to look at it theoretically or logically, or I'm looking at the charts, or I'm looking at the macro situation, all these roads point towards higher gold going forward. That having been said, and gold bugs get mad at me, or silver bulls or uranium bulls, whenever I talk about, you get a hockey stick chart, it's not unreasonable to expect some measure of correction. And, that's entirely possible, Kai. Anybody who tells you, no, it's impossible, gold has to go to the moon next, they're selling something. I wouldn't trust them. Absolutely.
Diamond hands, Yeah. We're not selling, we're hodling, we're diamond hands holder. Absolutely. Lobo, I have a couple more questions. You touched on it, and the tariff inflation impact. I caught it, I pretend I've caught it, but Jerome Powell used to say that tariffs are inflationary and not just a one-time hit. Like more on those, like, because not every good is going to be hit on the same day, so inflation is just a constant effect in the system until we're done with it. It's not a one-time effect, is my point. But now he said, well, it is a one-time effect. Did he pick up a book in between?
But he also said maybe not. I mean, I thought and I do think this was one of the moments when the market turned today, because if he had just said it's a one-time effect and left it at that, then everybody would have said, oh, so he's not worried about inflation. He is more worried about the labor market. So more cuts are coming. Woohoo, yay, Glover's gone, right? But that's not what he said. He brought it up to say, but there's reason to think it may not be so transitory, though he didn't use that word. And that's when I saw the market turning today. That's one of the things that I think was not baked in and did surprise people. As far as, where he could get the message from or whatever, I mean, just look at the ongoing negotiations with China. We keep being told we have a deal, but then something changes. Just lately we've got China telling its domestic producers to not use any NVIDIA chips, basically banning NVIDIA chips, which is a strong hit to NVIDIA, which is a big, one of the big pillars of the market rally we have now. And so this is maybe it's just a negotiating tool. Maybe actually I think it probably is. But it's really interesting because it reminds us, people were saying, oh, it's all about the rare earths. We got to make, China. It turns out, the famous with Trump and Zelensky, you don't have any cards. Well, she does have a lot of cards. The rare earth card turned out to be, if you'll pardon the expression, quite a Trump card. It was really powerful. And it caused the U.S. side to fall back and renegotiate. Well, whacking NVIDIA really hard, that's another high card, if not a Trump card. That's a powerful card. So if you're sitting here trying to make monetary policy and you're looking at how the whole tariff trade war is unrolling, it's not one and done. Liberation Day was not maximum stress, it turns out. It's an ongoing stress. And you have to rethink your outlook in terms of one and done. And then don't forget, like, even if there is a deal, well, A, those consequences need to work their way into the real economy. And then B, what about the ones where there isn't a deal? And what if there's retaliation and all that stuff? We still don't know where that's going to go. But at the end of the day, let's say 6 months from now, we have all the answers. Yay, all the answers, right? All the tariffs are settled. Oh, and by the way, for that to really be settled, we probably need the Ukraine war to be over so that the punitive tariffs, never mind the reciprocal, but the punitive tariffs for Russia cooperators or collaborators, all that's gone, right? We have a new stable regime for tariffs. We know what that is now. Well, that gives you room to say, okay, now that's one and done. That's behind us. Now, we had these price increases, but they're done, so the rate of change is back down again. Well, yes and no. What if all of that makes the whole world less efficient? Like we had this massive globalization for decades, and what if the new tariff regime can, that's already started to undo that? What if it goes further? And what are the not just one time, but ongoing effects of a less efficient global economy? So I think there's arguments to be made for it's not just the tariffs now, but it's the transformation of the global economy where everybody wants to become more self-sufficient, not just Trump in the United States. And there is an ongoing cost to be paid for that. That inefficiency of duplication of supply chains and production bases in multiple countries makes the entire global economy less efficient, that's more expensive. And as an Austrian economist, I want to say that all inflation is always and everywhere a monetary phenomenon, but it works its way into the real economy, and it's expressed in and policy responds to higher prices, consumer prices in particular. So there's an argument to be made for ongoing increases in consumer prices anyway, and that's bullish for gold. If we want to tie it back to that, I think it's actually bullish for everything. Again, I like to say everything real. And of course, I like JP Morgan's definition of gold is real money. Everything else is credit, right? So where do you want to go from there? But I think there is a case here. The politicians, none of them want to say it, but I think there's a case here for saying that it's not just the change in the tariffs now. That rate of change can go to zero, but the knock-on effects, have long-term consequences, and I do think they're inflationary.
Absolutely. I think there's an easy case to be made for that. Although all capitalism is deflationary because you always try to achieve higher benefits, right? I just had Louis Gave on yesterday or the day before, and he made an excellent case in explaining what he meant by that, and that we're actually in a deflationary boom phase right now, driven by China, India, and Russia, which is a really interesting, but that's a topic for another debate here. We're trying to stay on the Fed and the ramifications of what Jerome Powell just told us here. And I have one more topic, Lobo, before we get to more questions maybe from the audience as well, and that's more from the HR side. And I don't want to get political. I don't give a hoot about that personally, but it's Chris Waller. He's the guy who opened the door to jumbo cuts. That's when gold really started taking off. It wasn't just the Jackson Hole press conference where Powell was dovish, but it was also Waller adding, there might be jumbo cuts being discussed here. And all of a sudden, there was extra fuel to the fire. He didn't dissent. He stayed within the line. And if you look at the dot plot, and we had it up earlier, I can show it again, actually, here in a second. He didn't jump off. Like, we all believe there was Mirren, and I've said it out loud now, what we speculated on earlier here, that it was Mirren. And let me get it here just real quick.
Just real quick, not Mirren Katusa.
No, Mirren, Stephen Mirren. Mirren. Not Marin. But here's the dot plot again, real quick, and this is the descending, or let's say descending, but the outlier. That's the word I was looking for, the outlier. Then I think it is fair to assume that it wasn't Chris Waller. What do you make of that? Because he's President Trump's also one of the three candidates Trump mentioned to potentially succeed to Powell here. Wouldn't you think he'd be closer to this level down here?
I can't know. Like, my secret sources in the CIA don't have bugs in the Eccles building, so I can't know, of course. But if you want me to, I don't want to use the word speculate, because I use the word speculate as
educated guess.
It's a disciplined practice. It's not just a wild gamble. But if you want me to just flat out guess, I would guess that Powell, and this won't be in the minutes or in the notes, like, he got on the horn offline before the meeting and he said, look, if we have 3 dissents, or if we have dissents in different directions, imagine if we had not just dissents of whether it's 50 or 25, but imagine we had dissents like don't cut and dissents to cut more, like different directions, right? this will be really bad for the institution. It will be really bad for, even if you're on Trump's side, it doesn't help if, the market panics. So in order to avoid serious repercussions here, we know that Mirren, or whatever his name is, we know he's going to vote that way. So everybody else should toe the line, guys. Even if you don't agree this time, let's all be unanimous this time so that we can keep markets calm. There will be time in the future to cut more. So that would be my guess, because it's extraordinary for there to be only the one dissent when we had more last time, and the data is even more divided this time. It just makes no sense. Like, based on the data, we should have had more dissent, and more experienced Fed watchers than I were all expecting more dissents. And this was the immediate big surprise when you listen to the financial talking heads. The moment the statement came out, that was the number one takeaway. It was like, wow, we thought there'd be more dissent.
One would think so. He made a couple comments, and let's see if I wrote that down properly. But there was a slowdown in consumer spending, housing sector. I don't think that was the comment I was looking for. But he made a couple comments that there were stronger retail sales as well, that sort of balanced things out a little bit. I think, I don't have the exact quote here. I didn't write it down exactly, but it was right around those lines.
I noticed him say that, and maybe he thinks that. I don't know. I have to wonder. Well, retail sales is such a volatile number, but subject to interpretation. Like, why? People bought more ahead of Trump's tariffs. They front ran the tariffs, and we had a surge in retail sales. That didn't mean the economy was stronger, right? And now we've got, there could be another round of that as the new tariff set in. Like, what does that number mean? Does it really mean that the average consumer was happy and spending more? And the other thing that's come out since that number came out, and Powell even mentioned this too today, is that apparently, and I'm not sure how they get these numbers, but apparently something like 50% of that increase was in the top 10% earners. So it's not Joe Sixpack out there saying, hey, I'm feeling great, my job is safe, and I can spend more, take on more debt, buy now, pay later. That's not what's happening. The top 10% are spending so much that they moved half of that number, which means the rest, the other 90%, moved less than that, right? So I think it's dangerous to put too much weight on these things. And I think maybe even Powell recognized that slightly. But at the end of the day, I think the message here, dear audience, is you saw the Fed caught on the horns of the dilemma, the stagflation that Powell's whole plan for dealing with was not to let it happen. Well, guess what? They did, and they're stuck. And there's no good way out. It's damned if they do, damned if they don't. And it looks like, and at least based on the action today, they're going to err on the side of throwing the dollar under the bus. And that's good, again, for anything real, obviously including monetary metals.
It all favors that. Like, I might have mentioned it to you before, Lobo, but I have a hard time coming up with a bear case for monetary metals, like meaning gold and silver in particular.
It's just scary because it's exactly when you get overconfident that you fall flat on your face. So I tell you what, I don't know where the top is, Kai. I'm not smart enough to figure that out. And we've talked about this before. I have a strategy for my own investments, my portfolio. I call it the upside maximizer, which is sort of like using trailing stops, not as stop losses, but to lock in big gains. And so I've got a lot of big gains right now, especially in the gold space, right? So let's say gold rolls over. What's going to happen is my upside maximizer triggers are going to get hit one after the other. Boom, 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 boom. And if I don't get stopped entirely out, I will definitely take a lot of money off the table. And so what I'm saying with this is, and if you don't mind my saying so, there's a free report on the website, Upside Maximizer. But what I'm saying is, like, I don't need to know where the top is. If gold goes up to 4,000, I stay long. But if gold rolls over and it corrects, my triggers will get pulled, and I will be taking money off the table, so I won't get hurt.
Which makes a lot of sense, because nobody's ever gotten poor taking winnings off the table, right? Isn't that the saying? And
nobody goes broke taking profits. Yep, I love that one.
That's the one. right? I took some money off the table yesterday because I didn't know what to expect coming into this meeting. Usually Powell is quite good at pulling rugs, so I didn't feel like that happening today. And although like the market reaction, what is it? Gold is down 0.8% as we speak here now. It's sort of right, but it's just volatility. I don't think it's a proper trend yet, and I think you pointed out where gold might be headed here in the future earlier in the discussion.
If I was a day trader, I might was the market still open? No, just closed. I might have gone long right before market close on one of those short time options. Just because there's usually even if gold does actually trend downwards the rest of this week or next week. When you have a big move like this, there's often, if not a dead cat bounce or the inverse, the other way, either way, there's often on the next day, there's some big move, and the next day there's people saying, hey, wait a minute. So there's an opportunity I'm not a short-term trader, but if I was, a move as big as we saw today, I would have been highly tempted to make a contrary bet on that.
I'm with you, and I know a few people that actually bought puts yesterday, just betting on a bit of a reversal, just short-term, but betting on a bit of a reversal, just expecting the typical rug pull, right? And we've sort of seen it. Lobo, I'm out of my questions. Maybe we'll ask a couple questions by the audience here. We got a couple in,
Sure.
Sort of along the lines what we've been discussing. The question by CK is, with about 25% functional unemployment, 2/3 of the money supply printed in the last 17 years, he corrected himself in a later post here, home mortgage delinquencies and credit card delinquencies at 14 years high. Are we looking... Are we getting a new system? And he means by that a new metals backed money. Sorry, I'm butchering it. Metals blockchain backed monetary system. You know what I'm getting at.
So the answers are good, bad, and ugly, I guess. Eventually the answer is always going to be yes. Nothing lasts forever, so there will be a reset. But to me, as an investor, as a speculator, that's only useful if I can say not only when is it going to happen, but is it going to happen within my usual investment time frame? If the answer is yes, but it's maybe 5 or 10 years down the road, okay, that's not just a vague someday kind of answer, but it's not really useful to me right now. I'm not going to, positions can go completely wrong on me well before I'm proven right 5 or 10 years from now. And so the answer, to me is this going to happen in the next year or two? That is a much tougher call to say. And I'm not sure that it is. It was unbelievable to me that the powers that be could kick the can down the road after the GFC in 2008, 2009. I truly, completely did not believe that they could paper that thing over. And dangumit, they sure did. So, this has made me very cautious about assuming, it's Rick Rule's favorite thing, right? Don't confuse the inevitable with the imminent. I think this question puts its finger on, I think, inevitabilities at some point in the future. The house of cards cannot go to the moon. At some point, it has to come down. But I just personally, I would not invest on that basis because I have no idea when it's going to happen. And the belief that it's imminent has been very dangerous to people's wealth. It basically in my entire career.
Maybe as a follow-up, CK posted about the stablecoin bill. I'm curious if that is maybe the starting gun here that sets off the regime change.
That is a really interesting move. But you talk about what's going on, the number of unprecedented moves. This is really interesting. But to, again, give credit where due, I didn't do the math on this, but my fellow Puerto Rican, Adrian Day, looked at that. And, even if they're highly successful with this, the amount of money that we're talking about, it's marginal. It's not going to change the trajectory of the United States government's financial situation. It may help a little, but it's not going to change. It's not a game changer. Let's put it that way. It's not a game changer. And I'm inclined to agree. And I think maybe the most important thing about this is that, I liked Bitcoin better when it was this completely anarchic system and nobody wanted it to be regulated. They wanted it to be another kind of money completely outside of regular finance as an alternative to what happens if the mainstream or the establishment infrastructure goes up in flames. The more cryptos get sucked into the mainstream infrastructure and get regulated and defined and all that stuff, the more vulnerable they are to problems that they were in many ways designed to be the answer to. And I just think that's really unfortunate. But anyway, so this business now with the mainstreaming of cryptos and bringing in, the ability for the stablecoins to participate in treasuries, and there's some that are participating in the gold sector now. I think that's really interesting. Gold is a much smaller market than the United States Treasury market. And yes, there are some Bitcoin maxis out there that just hate gold. They'll never own gold. Doesn't matter how great gold is doing, they'll never own it. But I think most people, they want to make money, and they're not here to be religious about Bitcoin taking over the world in the end, like the One Ring of Sauron in Mordor. They want to look and see what's making money. And so there's an opportunity to make money combining gold and cryptos, whether it's with Tether or something else, right? I mean, that's really interesting. And it brings new buyers to the market, or even just new eyeballs, as it were. I think it changes the dialogue. It makes gold more appealing or acceptable as a hedge to people who otherwise might, said, oh, that's just a boomer thing, right?
No, it sort of not transcend, but it sort of like starts to blur the lines between crypto and hard asset, I guess, or digital asset and hard asset is maybe the right term. And maybe we can mention it, but it was Tether moving into the gold royalty space and buying a lot of gold, actually physical gold as well, somewhere between 1 ton to 2 tons a month for their gold vault in Switzerland, which is a really interesting development, of course. So, no, really appreciate that, Lobo. Appreciate those insights. We got a couple more questions. One is about Barrick Gold. I'm just going to answer that one real quick because it doesn't really have a bearing on the macro picture we're discussing. But Barrick announced today at the Denver Gold Forum their 4 mile, I think it was the PEA for 4 mile. Absolutely insane numbers. The market is absolutely excited about those. What is it, 600,000 to 700,000 ounces a year at an ultra high grade? I think it was 15 grams, Lobo. You might have seen it as well. 15 grams a ton within their backyard at Cortez in Nevada. That's why the market is so excited. So that was one of the questions we had here. The rest, Lobo, what has the market priced in now? Maybe giving a bit of a market outlook for the next 3 months until the year end. The Fed signals 2 more cuts. What is priced in now?
Well, let me jump back to Barrick a moment. I think,
okay.
and I don't give away stock analysis, right? That's what people pay me for. So I don't want to evaluate Barrick and put something on that. But I think this is really interesting on a broader market kind of perspective, because there's been a real increase in political risk in great jurisdictions geologically, but around the world, the number of governments getting more hungry for another pound of miners' flesh, that just seems to be getting worse and worse. And of course, it's understandable. You have gold hitting all-time highs. Of course, the governments are going to get greedier. That's just par for the course. So I think the interesting thing about this is that Barrick also just sold their last gold mine in Canada. And I remember my reaction to that was like, oh, because Pakistan is so much safer, right? So it's interesting that at the same time, now they come out with this news in Nevada. So, there's a balance here of the political risk game. And I think that is important. I think that's something that the audience should think about. I know that, people get mad at me when I say I don't like X, Y, or Z jurisdiction. But, sorry, Mali or Burkina Faso, they are more dangerous for your money than Nevada or Ontario. And yes, you'll pay more for a safer jurisdiction, but your risk is really different. As it happens, I just published a political risk map on my website. It's available for free. But I think this is important. And even, one of the world's biggest gold miners, they're clearly trying to keep this balance in mind. So, for people who are just swinging for the bleachers and buying dirt cheap gold stocks or uranium stocks or whatever in dangerous jurisdictions because they're cheap, understand that they're cheap for a reason, and you are taking a lot of risk. And what was your other question? Sorry, Kai. The sort of triggered me there.
No worries, because I know how that feels. That's why I had to bring it up, because it is such a market mover, and it's one of the leading stocks, companies in our space. So that's why I had to bring it up. But the follow-up, or the last question I had for you was really just trying to put a bow around our conversation here and wrap it up. It was really just what's your outlook now for the rest of the year? 22 more rate cuts expected. What has the market priced in?
I don't know. Well, what the market is priced in is that's coincident, or it's more or less what's been priced in. I'm skeptical that we'll actually have that happen, because I do think we're going to see more higher inflation data. So I think if the Fed actually tries to do its job of balancing between its dual mandate, I think we might get one or even no more rate cuts this year, depending on how quickly and how high the inflation goes up. And even if you're on team transitory again, if inflation goes back, 4%, that will be pretty scary. And even if you think it's one off, right, it would be hard to ignore that and just look through it and cut rates anyway. I mean, can you imagine the inflation, forget 4, let's say it goes to 5% by December. Can you imagine cutting anyway in December? That would be really tough. So I'm not making a prediction there exactly. I'm saying, though, that the odds to me favor a more difficult path for rate cuts than is currently being priced in by the markets. That aside, I think the broader picture is where we started. I think all roads lead to higher inflation. I think this is good for all real assets, not just gold and silver. I'm very bullish on copper going forward. Come the reflationary boom, I expect to be bullish on oil again, not right now. And we'll see other markets, other things, the iron, maybe even nickel, not so much cobalt, probably not lithium. I'll look at them as that happens. But I think all paths leads towards inflation. I think the big, beautiful bill and the Trump agenda in the United States is inflationary. I think Europe's remilitarization is inflationary. I think China, though it's nominally battling deflation right now, the policy responses, the stimulation, I think ultimately the printing press wins in the end. If you try hard enough, you'll get the inflation you want, right? Mario Draghi was gone by the time Europe got the inflation he wanted, but they got it. So I think the bottom line here is, and I don't know what headline you want to choose, but the bottom line is, I think we are looking at a super cycle ahead that is bullish for commodities as a class, but I think we'll need to be selective. It might work to just, buy the commodities index and ride it out over the next 5 years. I'm going to be more selective than that. And we haven't talked about uranium yet, and that one really is different. The real quick, the data says that in the last 4 recessions, uranium prices went sideways to up in 3 of them. And the one where they went down, that was 2008, and uranium had actually peaked in 2007, so it was already on its way down and arguably was not going down because of the recession. And I only bring this up because we've spent this whole hour talking about economics, monetary policy, fiscal policy. I think almost none of that matters for uranium. The build out of reactors around the world is huge. The demand case is soaring. Supply remains constrained. The miners have not been able to ramp up. Even the biggest and the best in the business, the 2 biggest and best in the business, have been unable to ramp up as planned. And this is extremely bullish. So this is not an economic statement. This is just simple supply and demand. I'm extremely bullish on uranium going forward.
Perfect. No, Lobo, really appreciate those insights. Also, the extracurricular insights here as well on the commodities. Much appreciated, Lobo. Everybody else, really appreciate everybody tuning in. It was great doing this live again. It's been too long, Lobo. Thank you so much for joining us. Where can we send our audience? Where can they find more of your work? You've been hinting at it earlier already. IndependentSpeculator.com. There's a free weekly letter. It's on the website now. We used to send it out via email, so you do need to register, but we don't charge for it, and we will not spam you with a flood of advertisements if you sign up. You just get one notification per week letting you know we've posted that free digest. And if you like the way I think, you might consider my paid services. Fantastic. Lobo, tremendously appreciate your time. It's awesome to do these live with you right after the Fed press conference. Much
fun.
appreciated. And everybody else, thanks so much for tuning into this live presentation, breaking news special here on Soar Financially. I hope you enjoyed it as much as I have. There's always lots to discuss. There are so many topics, so many nuances that can be picked up in those press conferences, especially this one. And I felt like I overhyped it a little bit the last couple of days here on our channel, but it was an important one for us from the precious metals perspective, and I don't think it disappointed. The contradictions are visible for everybody now. What's the Fed doing? Even the Fed doesn't know what they're going to do next, and I think that's the crux of the matter, and that's why we'll see volatile markets. Although the VIX is almost dead, looking at it, but you've seen it in the SP500, you've seen it in the gold price, you've seen it in the DXY just now. Let's see how that plays out over the coming days. I still have some cash on the sidelines. I'm ready to buy when the stock prices dip of some of the stocks I'm watching. So I hope you have the same. Good luck out there. Stay safe, and don't forget to hit that like and subscribe button. We much appreciate it. Take care out there. And we're offline.